China is experiencing serious economic issues. The housing market is crumbling. Youth unemployment has reached a record level. Growth has stagnated, and businesses are dealing with ongoing supply chain issues. The second largest economy in the world is grappling. Due to the effects of a prolonged drought, the country's sizable real estate market is currently experiencing negative debt ramifications. However, Beijing's strict adherence to a zero-COVID policy is making things significantly worse, and there is no indication that this will change this year. 8 megacities have experienced complete or partial lockdowns during the past 2 weeks. 127 million people live in these important hubs of transportation and industries. Since late August, at least 74 cities across the country have been cut off, impacting more than 330 million people. According to a recent estimate by Goldman Sachs, 35% of China's GDP is generated in cities that have lockdowns. The most recent limitations highlight China's unwavering commitment to eradicating the virus with the toughest controls, notwithstanding the harm. According to Craig Singleton, Senior China Fellow at the Foundation for Defense of Democracies, a Washington, D.C.-based think tank, Beijing appears willing to bear the cost of its zero-COVID policy because the alternative, widespread infections with associated hospitalizations and deaths, poses an even greater threat to the legitimacy of the government. Maintaining that legitimacy is more essential than ever for Chinese leader Xi Jinping as he campaigns to be elected for an unprecedented third term when the Communist Party convenes for its most significant congress in a decade next month. Restrictions on COVID will become more stringent during China's Golden September, Silver October, which is often the busiest time for property sales. A dramatic downturn in the global economy, meanwhile, is not good news for China's growth, according to Jung, as it would have an adverse effect on its export due to waning demand from the US and European markets. He now projects that the Chinese economy will expand by just 3% this year, far short of Beijing's stated goal of 5.5%. More pessimistic analysts are available. This week, Nomura reduced their prediction by 2.7%. Why it is important for Australia and beyond. Although people have been warned that China poses the largest military threat in decades, Australia's economic fortunes are intertwined with that of China. About a third of all trade between Australia and its trading partners is conducted with China. According to China's Bureau of Statistics, Australia's export to China, including Hong Kong, totaled $16.3 billion in June alone, more than doubling its $8.8 billion in imports. When the data series started in January 1988, trade had increased by roughly 140 times. Prior to COVID, China and New Zealand shared the top spot for the short-term visitors, with close to 1.5 million arriving there in 2019. Additionally, it contributed nearly 40% of all foreign students, which is roughly twice as many as India. China is the largest consumer of raw resources worldwide, consuming 70% of the iron ore exported worldwide, much of it mined in the Pilbara. However, according to Lori Milivirta, head analyst at the Center for Research on Energy and Clean Air, China's imports of coal and oil are declining. For commodity exporters, the weakening demand and China's drive toward energy and resource self-sufficiency will be a double punch. Beijing has continued to take a strong stance against the virus more than 2 years into the pandemic, including forced quarantines, widespread mandatory testing, and sudden lockdowns. The early stages of the epidemic were considered effective for the policy. In 2020 and 2021, China was able to contain the epidemic, avoid a significant number of fatalities that many other nations experienced, and create a speedy rebound following a record GDP loss. China's accomplishment in limiting the virus, according to Xi, at a ceremony in 2020, demonstrated the Communist Party's superiority over Western democracy. However, his hasty statement of victory has come back to haunt him because the zero COVID policy is less successful due to the more contagious Omicron versions. Giving up on zero COVID, though, doesn't seem like an option for Xi, who has consistently placed more emphasis this year on eradicating the virus than on saving the economy. Beijing's zero COVID goal appears unaffected, but the government has launched a flurry of stimulus programs to jumpstart the sputtering economy, including a 1 trillion yuan, or $146 billion, package released last month to build infrastructure and alleviate electricity shortages. The government is working to obtain the greatest possible outcome for job creation and economic growth while maintaining zero COVID. But Yung from ANZ noted that it is extremely difficult to balance the twin goals. According to recent data, the Chinese economy may have another disappointing third quarter. After growing by 4.8% in the first quarter, GDP grew by only 0.4% in the second quarter compared to a year earlier. China's manufacturing industry contracted in August for the first time in 3 months, according to official and private sector surveys issued last week, while the growth of the services sector slowed. Work and real estate issues. In recent months, the employment situation in China has gotten worse. According to the most recent figures, the unemployment rate for people between ages of 16 and 24 reached an all-time high of 19.9% in July, setting a record for the fourth consecutive month. A total of 21 million young people without jobs live in cities and towns in China today. Official statistics do not include unemployment in rural areas. Jobs are the most concerning problem, according to ANZ's Yung, who added that teenage unemployment may reach 20% or higher. More employment losses are anticipated this year, according to other experts, as social isolation policies damage the catering and retail sectors, which puts pressure on manufacturers. Another significant impediment is the deteriorating real estate market. The sector, which contributes up to 30% of China's GDP, has been severely hampered since 2020 by a government initiative to control risky borrowing and reduce speculative trading. Both the price of real estate and the sales of new residences have been declining. The zero COVID rules might be loosened in 2023, but following the Party Congress, housing policy might not change much. Mount property pains. Millie Verta thinks it's important to keep an eye on China's decline in steel and cement production in July because it coincides with the real estate downturn. The severe suffering in the real estate sector is reflected in the fact that steel was recovering but is now plunging once more. Developers' failures and the refusal of thousands of mortgage holders to make payments on apartments that might never be constructed make this suffering more obvious. The social internet is also rife with graphic photographs of undated demolitions and claims that up to 50 million apartments are vacant. Ironically, Beijing partially caused the crisis in an effort to rebalance the economy that was too reliant on real estate. Developers like Evergrande were affected by the following slowdown and defaulted on a portion of their $300 billion debt. 40% of developers were in financial difficulties, and mortgage boycotts posed hazards to both social stability and the economy. Harry Hu, an analyst at S&P, the strike should expand. They could jeopardize financial stability, particularly if they produce a rapid decrease in property values. S&P assessment that the boycotts may have an impact on loans up to 2.4 trillion yuan or $500 billion. A bubble of property with Chinese characteristics. Michael Pettis, a finance professor at the Guanghua School of Management at Peking University, has long spoken about the risk brought on by the 30 years of growing real estate prices. Although China's economy is around 3/4 that of the US or Europe, its property assets have grown to be twice as large as those of these two continents. The end outcome greatly misallocates resources while simultaneously inflating China's perception of its prosperity. Recent research by Pettis found that during relatively prosperous times between 2013 and 2020, about 40% of the homes that developers pre-sold have not yet been built. Property developers had relied on growing housing prices and soaring sales to justify huge borrowing and overbuilding. But as the market started to fall last year, these heavily leveraged real estate investors encountered severe credit and liquidity problems that prevented them from finishing their building jobs. The issue of aging. Similar to Japan, an aging and even declining Chinese population would exacerbate real estate challenges and hurt the national economy. If it hasn't already, China's population may be poised to start declining. According to Unravel, that would make it the first contraction since the devastating famine of the late 1950s. That article referenced forecasts of a 1.1% annual reduction after 2021 made by the Shanghai Academy of Social Sciences. By 2100, China's population would have more than halved, from 1.4 billion to 587 million. If that trend persisted, Jane Gawley, an economics professor at the Crawford School of Public Policy at ANU, cautions against listening to collapsists, who frequently forecast China's impending economic collapse. So, what are your thoughts about China's economic issue? Please let me know by leaving a comment below. And if you enjoyed this video, please press the like button, turn on the notification bell, and subscribe to Wealth-ology for more videos like this. Thank you for stopping by to watch. See you in our next video. Bye!